If you add more precision to what Bill said, the specific data I think is roughly the following, which is the two big underwriters of tech IPOs are Goldman Sachs and Morgan Stanley. And on average, they misprice and underprice IPOs 1 in 3 times. And they leave about, a lot of money on the table. I think it's approaching $1 trillion over the last 20 years collectively. Then when you factor in the fees that people pay, so if you think that you're underpricing a third of the time and you're paying a 7%, fee to go public, you have a 40% cost of capital. Now, that 40% cost of capital for a tech company is probably more than the cost of capital for North Korea or Iran or Venezuela. So you have to ask yourself, what is really going on here? And what is going on is that tech companies and founders have thought that they were the customers of Wall Street, but they're not. The real customers are the buy-side hedge funds, are the long-only funds, are all those folks who are going to be repeatedly buying stock over and over again. And what tech companies are is grist, and what the IPO is the mill. And so unless you break that system, what you're going to have is this repetitive underpricing, and the people that pay the price are the employees of these companies and the founders of these companies and the investors of these companies who are going to constantly be leaving money on the table. And the people who will be getting it are the people that have showed up at the last minute who have a completely different relationship with these banks that you know nothing about.
It's not as though the companies that have gone direct listing have just, shot to the moon, though. I'm just wondering what you make of the performance of the companies that have gone public through direct listing versus some that have gone through traditional IPO process. Hasn't been all, roses and birthday cakes.
None of this is to excuse business model quality and performance and discipline and operational efficiency and doing the right thing and extrapolating product market fit. This has nothing to do with that. This has to do with how do you make sure that you as a company are properly financing the business. And the whole point on IPOs that Bill was making is that companies who need money are leaving a lot of money on the table. And so I suspect that all these companies that went public probably would have found useful uses for the $1 trillion that they left on the table by working with the large traditional investment banks.
Adam, your thoughts on the same question, this direct listing versus IPO. I mean, I feel like we've got this developing, war is too strong of a word, but this, like the Valley versus Wall Street.
Well, look, I thought the Gurley piece was some of the most compelling business TV that I've seen in a really long while. It was sort of like the very end of The Usual Suspects, where you all of a sudden see what's actually happening before your eyes. Chamath plays a lot of poker. There's that old line about if you're at the poker table looking around wondering who the sucker is, it's probably you. And I think Bill basically showed that with data. In fact, I texted Bill after he was on TV and I said, that was incredible what you said. And he actually said, no, I didn't say anything. I just showed data. Look, to your point around the performance of direct listings versus a traditional, I will use a company like Zoom or a company like Slack. Both of them beat their numbers, raised their guidance for the year, and still got crushed by investors the day after earnings. So I don't see much of any difference overall in the market performance post earnings or post their first quarter. The fact of the matter is both of those companies are super high quality businesses. They just chose to go out public in a different way. I do think what you are seeing is this emergence now of traditional IPO, which obviously has a bunch of benefits to the company, including it actually brings capital onto the balance sheet for the company, or a direct listing, which also equally has interesting benefits. We also think, by the way, what we did with a SPAC may be this interesting place in the middle, which has some benefits of, say, the direct listing, but also brings capital into the business as well. So it may be the case that you're going to see a spectrum of these opportunities in front of founders and their boards to make, and I think that's great news for them to have choice, ultimately.
Chamath, lastly, I'll ask you the final question. I know you guys have to run and investors to do your thing with today. We sort of alluded to this a bit earlier, and it plays into the WeWork story, as Josh alluded to as well. Has Softbank been a force for good or force for evil in the Valley?
Well, I think it's generally been a force for good because the reality is founders have been able to find a ready source of capital. And from the perspective of innovating on things, they have been there. The question really is more about whether it is going to leave a great lasting impact in the ecosystem once this $100 billion is put into the ground. And I think there's a huge question mark. And the problem that it's going to create is we have created a whole class of capital-hungry companies who, because they could have raised, 200 million, did when they should have just raised 50. And they will find a way to spend that extra $150 million, but I suspect the product will not be $150 million better. I just suspect that there will be more La Croix and more, fancy food in the offices and more expensive real estate. And I think that's the tragedy of what's probably going to happen, which is overcapitalized companies will still spend the same amount of money in the same amount of time. So if you give them more, they'll just be more wasteful because it is very hard to drive an amount of money through a software business. You can only write so much code. It can only do so much. You can only hire so many engineers at a given rate and still be productive. And so money doesn't change that. And unfortunately, what we've done is we've extrapolated the expectations of founders to expect to have $200, $300, $500, $1 billion in a funding round when typically a lot less would have served them much better.
Yeah, this is the real last question to Adam. You think as a result of all this, Adam, you'll see companies go public earlier, sooner?
We're certainly not seeing that today. We're seeing companies staying private much later. The hope, of course, is that they come out with a higher quality revenue stream and a higher quality business model. Certainly, jury's out on that. It certainly is the case that if you go all the way back to the Facebook IPO, there were a set of people that were hoping that they either went out much earlier or much later. I think it's really hard to time ultimately businesses. I do think there is an opportunity if you go out on the earlier side for investors to ride the wave with you.
Yeah. Guys, you made a lot of time for us today. We appreciate it very much. We hope to visit with you again soon.
Great to see you.
You as well.